Live from New York, Investor Beat starts now. Thanks for watching. I'm Chris Hill, joined by Motley Fool co-founder and CEO Tom Gardner in our brand new New York City studio.
Exciting times here.
This is fantastic.
Yeah. There's a lot of good things to come out of this studio in the years ahead, no question.
All right. Well,
and in the minutes ahead.
And in the moments ahead. Let's start with some of the news of the day. Penney on the rise after their latest earnings. Probably worth pointing out they lost about $500 million for the quarter. The stock hit a 32-year low last month, and yet
These are not good things.
We're seeing a little bit of a bounce, and as we head into holiday retail, is it worth taking a look at Penney?
Well, first of all, Penney just isn't something that really interests me as an investor, so I don't spend a lot of time on it. But I did some extra research knowing that we're going to be sitting and talking about it, really thinking. And what I will say is, the first thing is that I love business and investing because there's so many different stories out there. We can laugh at any company or over-celebrate one that's going through good times, but what's happening at Penney right now, really requires turnaround expertise and managing the numbers. And what you look at, when you look at Penney's earnings right now, what you see is that their rate of decline of sales slowed. Doesn't sound great,
right? But
the rate at which demand is dying around Penney has slowed a little bit. And that means if it flattens out like this, Penney can turn this business around. Now, what can they turn it around into? That remains to be seen. I don't think that any of us see a glory story for shopping malls or businesses like Penney or their brand where it is today, which is why I have a suggestion.
Okay.
Which is they went with Ron Johnson, and I believe their next CEO should be Don Johnson. Because they were both
of Miami Vice.
They were both highly relevant in the 1980s. Penney and Don Johnson. Don Johnson dated Barbra Streisand. I think Penney would do great with a celebrity spokesperson. Bring in Babs and Don Johnson to lead this business. But overall, I'd say Penney, I wouldn't be surprised to see them turn it around, but I don't think that it's an investment that's worth the time and capital and risk.
All right, Yahoo in the news today. Yahoo adding $5 billion to their share buyback program. Is this a good move for them? And are you a fan of buybacks in general? That's one of those things that some companies pull it off really well, others not so much.
Investors should view buybacks in a very circumstantial way. Many of those buybacks that you see, particularly in technology companies, are simply to balance out the stock options that they've granted. That's generally a bad thing because what it means is that that's the primary reason for the buyback is to balance the options rather than to pick a good price. So you want to see buybacks coming at a time when it's a good time to buy that stock. You want to see CEOs like the CEOs at Chipotle who were buying the stock in 2008 and 2009 as much as they could because they thought the price was low. In the case of Yahoo right now, I would say that this looks circumstantially good to me. This is a buyback right before the Alibaba IPO, or at least they're announcing it. And I think what she's signaling to the marketplace is, hey, we're excited about Alibaba's IPO. We think we've got Yahoo pointed as a business in the right direction as well. So remember, if Alibaba is public at $120 billion valuation, $100 to $120 billion range is what they expect. That values Yahoo's stake somewhere between $20 and $28 billion for a $37 billion company now. So 2/3 of the value of Yahoo's business is banked on this IPO. And obviously Marissa Mayer is saying, hey, we think that IPO is going to go very well. We're going to be a long-term shareholder of Alibaba. And we think it's a good time to buy back stock, to borrow some money to buy back our shares today.
Marissa Mayer had a great rookie season, great first year as CEO. There are a lot of CEOs that come in to a situation where things aren't that great. They can turn it around in the short term. Year two, it gets a little bit tougher. We're partway through year two for her. How do you think she's doing so far?
Well, I mean, I guess I'll say I've heard Bill Barker say on our Market Foolery podcast, it's very good to follow a bad act.
Yes.
Right? And so I think Marissa Mayer made a great decision, and Yahoo made a great decision with Marissa Mayer. But let's also recognize she made a great decision in coming into Yahoo, that if you could just stabilize some of the fundamental areas of that business, the key areas of that business, and just stabilize leadership in the sense that they're actually going to hold this thing together, then you have a potential huge updraft with Alibaba's IPO. I mean, again, that's 2/3 of the value of this business. So at this point, I'd say year two is going to look great for Marissa Mayer because I think Alibaba's IPO is going to be successful. That's a great business. And I think she's also making some very smart decisions about advertising, how they're displaying their news, and bringing together just a more unified look at what Yahoo stands for.
Tesla Motors shares down this morning. The National Highway Traffic Safety Administration said that it's going to launch a formal investigation into the recent fires. We've seen the photos and the videos in some cases. we've seen these shares taking a little bit of a hit.
Yeah.
How big a problem is this for Tesla?
Well, first of all, I hope the stock goes lower and lower because I would love to be a shareholder of Tesla. And I've just been waiting for my price, which has been a mistake. I mean, we have it recommended in Stock Advisor, but not in the Everlasting portfolio, Motley Fool one, the real money portfolio that I manage. So overall, I want the stock to go down. So I hope the news about this just keeps swirling
You're
around
rooting for a couple
the
more
reality
fires.
is they've had a couple, they've had a couple fires, okay? If you compare that to the rate of fires in gas-powered automobiles, come on, it's an absurd story that's out there right now. But the reason the story is out there is because they are the highest profile automobile company really in the public markets now. It's the one that everyone's excited about, and that means that every little nitpick that people can have is gonna be magnified. And I know Elon Musk is out on Twitter, responding, and I think that's great in a way, but I also think that the real long-term story of this business is not gonna be about this situation. It's gonna be whether or not they can really scale production to meet the demand. Remember that the tough Tesla quarter that they just went through, which wasn't tough at all, but the tough news was that they're not able to scale production at the pace to meet demand. And if you believe in this business long term, that's great news for you to buy this stock at a discount. And hey, shares are down from 190 to 120, so I think it's starting to look attractive.
Finally, as we wrap up, we got a week to go until Thanksgiving. Anything on your radar that you're looking at in the next week before we take a break for Thanksgiving Day?
I mean, I would say I'm trying to size the mashed potatoes correctly, not to overload the plate. Try and work some. Maybe I'll work a Brussels sprout in on
strategies.
The plate.
Sure.
Yeah, strategies. That's really what I'm focused on. I think that's what most investors should be focused on with their family at Thanksgiving. Really what I'm focusing on as an investor is whether or not I and everyone out there can reset your expectations. I think it's a good idea at the end of each year to really look back, maybe look back 5 years. I like the 5-year time holding period for investors. So if you go back 5 years, we've had 15% a year over the last 5 years. The problem is that as that happens, investors begin to anchor on that and start thinking, I bet if you ran a survey of the general investing public now, they'd say, I'm starting to expect maybe 13% next year or 16% when we know the average rate of return for the stock market is 10%.
Can't we just have a repeat of what we've had in
We
2013,
all want that.
year after year?
We want what we've had the last 5 years. Now, the 5 years before that, the stock market was down 3% a year. So you had down 3% a year and then up 15% a year. So I think it's a really good time to reset your expectations to say, hey, you know what? If I get 6 to 7 to 8% per year out of the stock market, and if I can beat that over the next 5 years from here, that's going to be a very nice 5-year return. And that's tough. It's always tough to reset your expectations down, but it's important to get your portfolio allocated in the right way.
All right, good advice. All right, for Tom Gardner, I'm Chris Hill. Thanks for watching. We'll see you tomorrow.